All right. What is up? Welcome to REI 101. This is where we learn and teach about real estate investing. Whether you're a seasoned investor or you are new to the game or just wanting to dip your toe into the water, we are here for you. I'm your friend, Austin from Houston. This is my brother, Alberto Medellin. What day are you on? You're close to like day 250 of
Today is day 250. You got it right.
nice, dude. Yeah,
First
I'm
shot.
I'm starting to like TikTok just a little bit, but
Starting to follow me now.
yeah. Yeah.
Everyone should follow me on TikTok. Run Invest. RUNNINVEST. You get lots of running and a little bit of investing in there.
Dude, we should do a few episodes where we just run and talk investing.
Yeah, we can do that.
We could do that. All right. So how was your week? And talk to us about the big race.
The race was fun, man. It was. I've done a Ragnar relay before, which is pretty cool too. And everybody I think runs it's an ultra team, so we all run 31 miles anyway, but it's much longer. It's a much longer. It's like let me see, it's like 120 miles, that one, or 124 miles. But we ran
Ragnar, like the Viking?
yeah, Ragnar. I don't know if you've ever heard of Ragnar trails. They're like relay races.
Mm-hmm.
So, anyways, it was 100K, which is about 62 miles that we split amongst me and my running partner. And it went well, man. The weather was good. It was cool to start, breezy. It was like maybe 52 degrees to start, warmed up to like maybe 70, 72 degrees. Bunch of hills and like a bunch of these stone steps that we had to climb.
Nice.
It was like 20 loops. And so, but we got done in about a little over 12 hours, like 12 hours and 11 minutes, which was a really good time. I drove home and got home that night, took a shower and slept in my own bed. So
Nice. I'll take that.
it was
For
up in
real.
East Texas, kind of near Crockett, Texas.
Yep.
Yeah, not too far from home, about 2.5 hours from the house. So it was fun, man. It was a
Well,
very beautiful day.
congratulations. So what's the next race looking like?
The next one probably isn't until June or July. I got my trip to Puerto Rico coming up in about maybe 3 weeks.
Okay.
And that's going to be out for a week. So I'm not really trying to do too much before then. I want to be nice and fresh. Excuse me. I want to have some fresh legs because I know we're going to do a lot of hiking and walking and stuff like that. So
Yeah, man, that's
really
gonna be
nothing planned
awesome.
until maybe June or July. And then after that, there's really no races until the fall.
Okay.
So
Wow, that's gonna be great, Puerto Rico. You're
yeah,
just gonna go see the sights and do some hiking?
yeah, I've never been. And so Julia, it's kind of like a family vacation. So her parents, my in-laws are going. So it's going to be fun.
Awesome, man. That's great. Well, today is it's May. Today is May, and so we are kicking off our May vendor series, and we have a very, very special guest joining us on the call today. But this month, investors, you need to watch the replay, go back on YouTube, take good notes because we have 4 weeks. We're going to focus on four different vendor relationships and some of the nuance that occurs with that. So these are the pieces of your chessboard you want to get on before the game starts. So I want to invite our guest Magdiel Garza. Magdiel, what's up, brother?
Hey, good afternoon. Can you hear me okay?
We can hear you. You sound great. Hey, thanks for
All right.
returning. You were on like episode 2, and now we're on episode 53, and you're
Wow.
back. So, Magdiel Garza, South State Bank. Tell us about what you're doing and why we need to be in business with you.
Yeah. Well, we are doing a lot. We are still lending, which is, a good thing always. We are a fairly new bank here to Texas. We have bought out the old Independent Financial for some of you guys that are familiar with them. But it is a very established bank out of Tampa, Florida. $67 billion assets under management. But I myself am a Houston local. For those of you guys that have not met me yet, born and raised here in Houston, have been in the banking, commercial lending industry for about 26 years now. So I bring a lot of expertise and really all things investment real estate, commercial real estate, everything from your shopping centers, strip centers, office buildings, warehouses, multifamily, even single family portfolios, things like that we can help with. We've even started to, well, I guess not started to, we've always had a great builder program. So we're able to help with folks that are building either townhomes or single family residences or multifamily. We can help with those as well.
Nice.
Well,
like
I think we're Albert and I are both going to have a lot of questions for you today. So we're gonna go super rapid fire and
Okay, and quick disclosure, I've been at this particular bank. I'm still fairly new, so still kind of learning what their appetite is. So if I can't answer any of those, I will put it in the parking lot, and I'll definitely come back to you guys either on next episode or one
you
off.
mean you don't know everything?
I know, surprise, surprise. Right?
So talk to us about what's happening, what we're seeing in the market. There's global uncertainty, the whole world's coming to an end, and then there's a lot of people that view things totally different. What are you seeing trending? You know, maybe not, you know, what's happened over the last 2 to 3 years, because on my side as a broker, and Albert's, you know, comes from a different side, a little bit different side also. We have come up against some challenges when it comes to obtaining financing for various asset types. Are you seeing any changes in that, or you think things are still trending in the same direction?
Yeah, so a couple of things I've seen, and this is not anything new. It's been about a year going now, and I know you and I work together very closely, Austin. So we've run into this quite often. Is that sometimes the sellers have not caught up to what the market's doing,
Hmm.
especially in multifamily and things like that. And so, uh, you know, with a bit higher interest rates, things are becoming a little bit harder to cash flow. Some of the loan to value, you know, kind of processes that we've had in the past have dropped a little bit. So instead of us doing, let's say, 80% loan to value on an apartment complex, we're now scaling that back to about 75% loan to value, things like that. And so what that means is your investors are having to bring more money in to the
Hmm.
deal, either to make it cash flow at the debt service coverage that we need to, which in our case is now 1.30. So,
Okay.
and by the way, if there's any
that.
questions, you guys pause me. But so, you know, in the past we were at 1.25 was the debt
Yeah.
service coverage ratio that was acceptable. That has now gone up to about 1.3. So, again, you know, direct result of what we're seeing in the market. Um,
Do you
we
want to
have
break
run
down
into some,
the DSCR? Because
yeah,
we've spoken about that before we dive into it. Can you kind of help us understand what you mean by
yeah.
1.3, 1.25 DSCR?
Yeah, so backing up just a bit, I know your investors, you guys typically focus in on cap rates.
Hmm.
Banks in general, we don't really underwrite to cap rates. Cap rates are more of, I guess, to see if for you guys, if that's a good deal, it's a viable deal that you guys want to get into. But for us, it's all about repayment. It's all about cash
Hmm.
flow. So we want to make sure that the property, the asset that you're purchasing, is cash flowing on its own when you're purchasing it. And so, um, you know, we'll look at the NOI and compare it to what your debt service is going to be for that asset. So essentially, what your annual payments are going to be.
Got it.
Um, and
Uh-oh.
Did we lose Magdiel?
Kind
Okay,
of cut out.
so what he's trying to say is, so the simplest way that I know to explain that debt to servicing, it's basically how much money is left over after the mortgage is paid. Are you back with us?
okay, I'm back. Can you hear me? Okay.
Yeah, so
Yep.
I was saying that the
Sorry about that.
simplest way to explain a DSCR is that's how much money's left over after the mortgage is paid on the property.
Yeah.
So when you
Yeah.
say 1.30, for every dollar that's being paid on a mortgage, we need 30 cents left over to,
Absolutely.
and that's probably a good rule of thumb, whether you have a DSCR loan or
And the way we calculate that is just literally divide the NOI by the annual payments.
right.
And that's where you get your debt service coverage ratio is what they call it. And so that has to be 1.30 or better for a bank to really see that it's favorable. So those have changed a bit since we call it 2 years ago. And then one thing we're looking at, there's two other things that we're really kind of focusing in on now is the strength of the borrower. So if this is, for example, a property that you're buying with your last, lack of a better word, kind of your last dime, we're a little leery of that because we want to make sure that some vacancy is there or some capex that you need to do on it, that you have that money available and you're able to kind of weather any kind of storm if rents are dropping, which I'm sure you guys have seen, things like that. And so we want to make sure that the borrower has liquidity left over
Yeah.
after they do this transaction. And then the last thing is, obviously, some things haven't been appraising. That's come back quite a bit, and they haven't been appraising for what we thought. So I've had two now that have, kind of made the deal go sideways because
Low appraisals.
once the appraisal came in,
Is that on a
was like
specific
90,000.
asset type or is that in a specific location?
I haven't really noticed the location. It's just been kind of across the board. I've seen it on multifamily, and I've seen it on it was a gas station. But yeah.
So
but I don't know if you guys have seen that on the residential side or not.
Yeah, on the residential side, yes. So tell us, like, what caused the buyer to be off on their numbers? Because ultimately the buyer bought it, the buyer's overpaying. So when appraisal comes in low, the buyer is essentially overpaying for the property. What threw them off on that? Like, what was off about it?
So the buyer came in full asking price of this apartment complex, and when the appraisal came back in, I guess the agent or someone had ran their numbers, ran their comps, and the comps seemed to be pretty spot on. But unfortunately, the appraiser was, from what we saw, he was adjusting for what's going on in the market. So rates, I'm sorry, not rates, lower rents and just different things like that. We're actually still, we're sort of in the middle of that because we're trying to go back to the appraiser and see if we can kind of get something done. But yeah, so that's one of the things. The other one was a gas station, and that just, it was other factors that went on there. But I've also I work closely with other mortgage brokers, and they've told me the same thing, that they've had some appraisals that have been low. So obviously, as you guys know, I mean, you can make money in a up or down market. So it's just about making sure you're finding a really good deal right now, is what I'm saying. Some of the mitigants that we can do if it doesn't cash flow, if you bring a little more to the table, that obviously can make it cash flow. So now your payments are lower, debt service is there, or debt service coverage is there. The other thing is this gives you a little bit of leverage to go back and say, hey, the bank will only approve us for this amount. This is what they think it's, a good price is, and there's more negotiating power there. So that's also something that we've seen some of our buyers doing.
See, with those lower appraisals, do you think there's some opportunity there to renegotiate? And are you seeing buyers having success renegotiating once they get a lower appraiser, or you have sellers that are kind of stuck at that number?
Yeah, I am. No, I am seeing sellers sort of be realistic because they know that most appraisers, I mean, they're going to get the same answer at the next appraisal. And so, yeah, I have seen them sort of meet in the middle is what I've noticed. It hasn't really been, they'll drop it all the way down to what the appraisal says. And so they sort of meet in the middle, but it's benefiting the buyer.
Yeah.
They're having to come out of pocket just a bit more, but they're, and their payments are lower. So
got it.
It's cash flowing a little better.
Berto, you've been running into appraisal issues on your side?
Well, not really on the single family side. No, not at all.
No, good.
Yeah. We've, even like we've been across the board with our price points as far as like what we're bringing to market. We're kind of at the entry level, like 200, 220. Then, we sold one in the Heights for, I don't know, 680 or 670. It praised just fine, and it was on a busy street. But we're not really having any appraisal issues, not on the single family side, but what we're doing now, we're just kind of a mom and pop, right? We're not doing, volume, but from what I'm hearing too from other investors that are doing a lot of flipping, they're probably flipping two houses a month.
Hmm.
I haven't heard anybody really complaining about appraisals on the single family side.
Oh,
So
good. Okay.
yeah, it's been good.
Yeah. And those could have been just coincidentally, one-offs or whatnot. But yeah, so that, I mean, that's a good sign. And
Yeah.
not
Yeah.
too tuned into the single family as much, so that's good.
Yeah,
Good to
you've
know.
covered a lot of kind of a lot of the things that I would ask as in like if I were a new investor approaching you, trying to understand what your DSCR ratio is, what
Hmm.
that is, and that's super important. I just remember back in 2020 and 2021, at least on the single family side, we were working with a lender that was zero point 0.8. So they were even like
Wow.
below 1.0.
Yeah.
So
Wow.
now we were refinancing those at 75%. So we weren't going up to 80% on the single family side. So, we weren't too far leveraged. The only thing that was kind of standard pretty much for single families is about 75%. Most of our
Mhm.
refinances still happen about 75%. I know there's a few lenders on the single family side that do up to 80%.
Mhm.
But with our rents, right, we're trying to get those rents, the mortgage payments a
Hmm.
little bit lower so we can cash flow on those long-term rentals.
Yeah.
So
Yeah. Yeah.
Magda, one thing you said is
mhm.
that you're starting to look more carefully at the buyer's position. This in the commercial side of investing, go back to like 2021 through 2023. It had a lot more to do with the performance of the asset. You go back maybe like 10 years ago, people were borrowing based on their buying power. Like what what causes what causes the shift? Like why does it go like I guess depending on the market, the focus is more on the asset versus the borrower. Like
Mhm.
what causes that shift? Why are we looking at the borrower more than the asset type now, or is it about equal?
So, I don't think it's more. I think it's more of where you're getting your financing from.
Hmm.
So, if you're looking at a traditional bank, they tend to look more at the borrower. If you're going a little more alternative, things like that, there's so we're first and foremost, most banks are cash flow lenders, and so
Hmm.
that's obviously what they look at first. Everything else is secondary. But there are a lot of asset-based lenders or collateral lenders out there who are going to focus in more on just the asset. If the asset is cash flowing, or if the asset is what they like, then that's what that's about the last thing they'll look at. Um, and so that's kind of where it starts. But secondly, obviously, if the market's doing better, they're just more confident that if worst case scenario, they can always the
Of course.
resale value is going to be there, things like that. So it's just really when a market tightens, everything kind of is looked at a little bit,
So
more
it's a little bit higher risk situation these
Mhm.
days, just
Mhm.
with
And, and let me just throw another caveat in there. If it's an experienced borrower who has several multifamilies now and is managing a few and has done this for years and has money in the bank, all those good things, even if that particular property does not cash flow, we can make an exception and do what we call global cash flow, meaning
okay,
we look at the full picture and say he may not be making much on, or he may be just a bit off on this one property, but he makes so much on his other properties that he can, carry the
you could
load, if you will.
justify it. Yeah.
Absolutely. But if this is someone's maybe first apartment that they're going into, or first, things like that, or they're just, like I said, not very liquid, then we're gonna want that asset
Got it.
to to kind of cash flow on its own, if that makes sense.
Got it.
Mhm.
Got it.
So there's some gray area there. Mhm.
Nice.
So talk to us about getting approved and kind of getting started. I know
Yeah,
you're working with a lot of, and we refer a lot of business over to you. We,
absolutely.
you, you see a lot. What are some of the common mistakes that you're finding that borrowers are making during the lending process?
So, um, where do I start? No. So the first would be to really, I guess, even from y'all standpoint or your standpoint as an agent, I think the first question I would have would be to just really make sure they have the down payment for the property. Some borrowers, as we know, may only have 10% down or whatever it may be, and they maybe hope that maybe someone can carry a second note, things
Hmm.
like that. Those days are pretty much gone, at least for traditional banks. They're not okay with maybe a seller carrying part of the down payment as a note. So that's the first thing, making sure that they're liquid, they have enough money.
Yeah.
Secondly is just being very candid. If it's their first multifamily, it's going to be a little tougher. It's
Hmm.
sometimes could be a bit of an uphill battle if they've just never really had any investments and they're starting with a multifamily. Sometimes if they started with several single family,
Yeah.
then it's a little easier. So the experience obviously is what I'm talking about. And then for us, it's just really getting good T12s and rent rolls and things like that from the property that they're purchasing. If they're purchasing a property and they just don't have a lot of financial
Hmm.
information on it, makes it a little more difficult to get done. So these are all just things that we're having to, it's I would say it's not one thing that's wrong, it's typically a number of things, right? And so once we get it all compiled, we're putting together a nice summary, sending it up to underwriting and seeing if they like it. So if the debt service is there, they keep good books, the borrower has a good, nest egg there, just kind of something for a rainy day if
So you're talking about
there's
more
some
in
runoff.
addition to like the 20 or 25% that they're putting down, having
Yeah. Just several months worth of, you know,
well,
kind
emergency
of.
fund.
hmm hmm
What?
Yeah.
So um, on the flip side of that, we're seeing borrowers make quite a bit of mistakes. You're mentioning financials, T12s, all that. What if I want to go buy a 12 unit apartment complex and it's vacant? It's empty. Like, how do we make that type of a deal work when it has no financial performance?
So if it's empty, how long has it been empty? What is the last, information that you can get from it? And let's say worst case scenario, you just have no information that you can get from it. We can make assumptions off the market, so what's the
Hmm.
market rate going? What where the rents going in that area? But just again, being very honest with you, that is going to be an uphill battle
Yeah.
because everything is based on projections, and most banks like historicals, not projections. That we always say we're driving a car, we're always looking in the rearview mirror, not looking in the front. In front of you because that's all projection. It may happen, it may not. It may take longer than expected to get it leased up,
Yeah.
stabilized, all that good stuff. So, what we do, and this, Austin, is we do have other lenders that are alternative lenders that we work alongside with. And sometimes for a situation like that, we may need what you call a bridge loan. So we
Yeah.
send it to them. They would finance it. And those are the ones that I was saying are more asset based. So
Hmm.
it's just, is the asset good? Do we like it? They're not too worried about historical cash flow. So they'll
Got it.
finance it and it'll be a short term, 1 to 2 year till it gets stabilized. And then I come in and take it out on a longer term loan. Those may be a little bit higher in the rate, but typically they're interest only, so the payments are still manageable, and you can get it off the street, if you will,
That's
and
called
and get going
teamwork
on it.
right
It's
there.
called teamwork.
It's
Yeah,
called
I
teamwork.
always say
Getting
it.
Albert, do you have
Yeah.
anything else?
Um, yeah, I mean, I just kind of interested in as we kind of progress through this call, we're talking about just what's needed right on the buyer and seller side. Like for me, for instance, I think what I would ask Magdiel as being an investor. So let's say I'm looking at a multifamily, mostly everything that we look at is going to be value add, right? There's going to,
Mhm.
it's going to be in some kind of distress, some physical, some property distress. And so does where you work, do you have products for that type of purchase where, you know, let's say it's just like a fiveplex, like something small, right? I'm starting small. I've got 10 single families. I've been doing it for 5 years. I'm managing 8 other ones over here and then some Airbnbs and things like that. So I'm looking at a fiveplex. So it's on the commercial side, and it's vacant, right? There's a triplex and a duplex on the same lot. It's vacant, needs a ton of work, right? Might appraise at about 800, 900,000. I can probably get it for about 300 and have to put, 200 or 250 into it. Like a lot is a big, heavy lift. Do
Hmm.
you guys offer products where you can cover either the purchase? I mean, obviously, I have to bring money down. Like, what does
Sure.
that look like? How will we structure that deal? Giving my
Yeah,
experience in this particular property.
yeah, that's a great question. So, given your experience based on the scenario you gave me, I would say we would go global, first of all. So we would ask for a personal financial statement that just
Hmm.
sort of encompassed everything you have. And then I'm assuming you have a property holding company. We'd ask for 2 to 3 years worth of tax returns, the financials on that. Um, we put everything together, and then we say, okay, that property that he's purchasing aside, could he make the payments based on what his income is now, what his cash flow is now? If the answer is yes, then we could move forward. Unfortunately, we would not really. It's a little difficult for us to actually give rehab money
Okay.
so we'd probably just fund the purchase, and we'd
Gotcha.
ask that you guys do rehab out of pocket.
Hmm.
Um, as I mentioned to Austin, I know he knows what I'm talking about, the gentleman Jose. So I have a buddy who I would send a deal like that to if you really just said, "Hey, no, I do need the rehab. I need the whole thing." I do have, like I said, another lender that I work alongside with who could do that deal once the property is completely fixed and you've done everything you need to do to it. It's stabilized, leased up, then I can come back and take it out on a 25-year amortization period. He would do it probably for 2 years, just interest only, to kind of
Hmm.
get everything you need done, and then we'd come back and just refinance the whole thing. But at that point, it's showing steady cash flow. It's
All right.
leased up at least 80, 90%. Everything that needed to be done was done. So that's kind of how we work in tandem to get things like that done. That's kind
But
of how I would probably handle that scenario.
on that side, I don't know if you can really speak for him, but on his side, is it more of a lower doc type loan, or is it a heavy doc
Hmm.
loan like this one?
Very low doc,
Low
very
doc.
low doc.
Okay.
But you're probably looking at, just to kind of put some, just a few examples out there. For me, you'd be looking at about 6.5% rate on the
Right.
longer term
On
deal.
the long term
He'd
side.
probably be closer to maybe 10, somewhere in
Right.
there.
Hmm.
Yeah. And then probably
Um,
like 20% down on like whatever the
mhm,
purchase, or maybe loan to cost like 20% down or something like that.
exactly. Yep, you're spot on. 20% down. Um, interest only,
Interest only. Right.
interest only payments.
Gotcha.
Um,
Okay.
so it can be done. Uh, just kind of need to know what you guys are looking to do, and then that's when we can step in.
When you work in tandem, are your companies connected where maybe we can just save on closings, right? Because when I'm doing the purchase and the rehab, like there's a closing and costs associated with that. And then on the refi side, right, there's closing costs and things associated with that. I've worked with some hard money lenders that try to do everything all, together, and it just doesn't
Hmm.
really pan out great. I mean, I've tried it a couple times. It just wasn't a good experience, to where it's gotten to the point where it's like, fine, it is what it is. It's in my underwriting. I'm just going to close here on the hard money side or on the private side and then pay those fees. And then, in 9 months, 12 months, 18 months, whatever, I'm going to go refinance this and I'm just going to pay those fees there.
Yeah.
Do y'all have something where you work together on trying to reduce those costs to
Um,
investors?
un Unfortunately, we don't, and the
Okay.
only reason is because we're not in any way associated with each other.
Gotcha.
This is just more of, I've been in banking 26 years, made a lot of connections, and what I try to do is those folks that I really think are on the up and up and can really help and are honest and help clients and put clients first. I'll make introductions to folks like
Sure.
that, and so. No, I have heard that at certain title companies, if you're closing at the same title company, a lot
Yeah.
of times they can do something on those kind of fees.
It's pretty
But
minimal though, like what they can do. Yeah.
yeah, yeah, yeah. Um, it does benefit you guys to do a new appraisal anyway. I will say that part, obviously, because
Mhm.
now you're getting the higher LTV. But yeah, unfortunately, that's there is I guess, essentially a double closing on that. Yep.
Yeah.
Hmm.
Yeah.
Maggie,
Yeah.
And
we
yeah.
appreciate your time. We know you you've got to run. But real quick, how do we get a
Yes.
hold of you? We need money. You got money. How do we make this work?
Yeah, absolutely. Let me read you out my email address or phone number, either one. So I'll start with my phone number. And Austin, you're more than welcome. I'm more than welcome to give my information out after. But my phone number is 832-403-8236. That's my direct cell number. You can reach me directly. I'm over in the Westview area here in Houston, but I go wherever the business takes me. And then my email address is Magdiel.Garza at SouthStateBank.com.
Perfect, man. Thank you
Yeah.
for joining us today. Appreciate that.
Thank you guys. Thank y'all for having me. I look
Thank you.
forward to working with y'all, continue
Yeah,
working with y'all.
we'll get you back.
Absolutely.
Get you back.
Sounds good. Thank you,
So
gentlemen.
thanks, man.
All
So
righty. Bye-bye.
Albert, there's a lot of different ways, we can take these deals down. And he hit, he just kind of barely touched on a lot of things. One thing
Mhm.
I wanted to ask, and maybe you can answer this, is how much do those rates do they matter? Because I think a good investor, they're going to look at the terms, of the loan just as much as they're going to look at the deal of the loan, right?
Right. Yeah, absolutely. I think, whenever we had the jump in rates back in like June of 2022, when
Hmm.
rates just really shot up, I think that got a lot of people, or took a lot of people by surprise. They weren't
Yeah.
expecting that, right? They were underwriting deals at like 4.5%, 5%, and then all of a sudden they were getting quoted 7.5% and 8%.
Right.
So that big jump at that particular point in time, Austin, yes, I think it impacted cash flow, especially on the single family side, definitely. But
Hmm.
I think since then, right, it's been 4 years now since that all happened. I think
Yeah.
we've all become accustomed to what are kind of rates going today, right? And there's not really that big of a difference between like single family and the commercial side, at least
Right.
the smaller multifamilies, right? Fives and tens.
Absolutely.
There's not really that big of a difference. There used to be, right? There used to be like almost a 1.5 to 2% difference between someone who's going to go get like a conventional,
Yeah.
or even like an investor loan in their own name,
Yeah.
right? Or someone going to go get like a DSCR loan in an LLC. There was like sometimes a 2% difference.
Yeah.
Now that gap is closed a lot. So we do look at the terms, of course. Yeah, we look at the terms. We look at the deals kind of with the end in mind, right? Is I think the bigger thing for us, which we've talked about before, Austin, is not necessarily the loan terms. It's more of the insurance costs and the taxes that continue to rise. Like
Yeah.
I've seen that with our students. I've seen that in my portfolio, how there's only so much we can pass on to our tenants, to our renters,
Yeah.
because we're feeling it, they're feeling it. Everyone's in the same economy, right? When people talk about prices are going up and things are getting more expensive, it's impacting everyone.
Yeah.
So it's really hard for me to just pass on every single penny that goes up for me onto my renters. I
Right.
want them to stay. I don't want them to have trouble paying rent. They've got to buy groceries. They've got light bills. Obviously, we're there to make money. We're a business, but we're just, we kind of get caught whenever those insurance costs and
That's
taxes
a
go up.
great point because yeah, your tenants, what they don't care about your expenses. They don't care about your taxes that doesn't affect them. What affects them is if they have to move out, how much is it going to cost for them to find a similar price, similar home
Right.
for them to
It's a
live
pain
in?
in the butt for them to move out, obviously. I mean, and that costs time and money. Like whether they're hiring movers or not, I mean, they've got to maybe have to take off work to go do things, or they're doing things at night. It's just a pain in the butt, right?
Yeah.
On the landlord side, it's a pain to have a tenant turnover.
Yeah.
We've got to come in. There's going to be normal wear and tear. That's just normal, right?
Yeah.
Touch up paint, having it professionally clean. You're doing pest control. You're probably having to cut the grass again because they probably let it go the last month that they were there. They're moving
Yeah.
out anyway, right? There's a lot of costs associated with those turnovers. And then you have to go through tenant screening and searching for another tenant.
Yeah.
Like you might not get another tenant for a month or two. Then those mortgage payments don't stop,
Yeah, and
right?
that math is very simple because if you're waiting for somebody to pay $25 more than That's only $300 difference in a year. But if you wait
But
a
it can cost you
month,
a lot more than that to do a
yeah,
turnover.
your $1,600 rent is gone,
Yeah.
and you're trying to save
Plus those other
300.
expenses. Yeah.
So
And
no,
again, what
just
if it goes 2 months, right? You're
yeah,
$3,200 now, and all of your cash flow for the past year or 2 years just gets wiped away. So, we have really good relationships with all of our renters, all of our tenants, even the ones that we manage for our clients. We stay in contact with them. We talk to them.
hmm
We talk to them probably once a month, at least through like Rent Ready, our rent collection software.
yeah,
Some of them pay late, they pay late fees, things like that. Or some of them have some issues that we kind of help them work through. There's maintenance requests and things like that we address quickly. So we're kind of always kind of front of mind for them. So
yeah,
when it comes time to renew that lease, it's kind of an easier transition to talk to someone about a rent increase if you've been in contact with them for the past year,
yeah,
right? If the only time that you talked to them was when they signed the lease 12 months ago, and now you're sending them an email about a rent increase, they're like, no, I'm not going to do that. Like, I'm just going to move,
yeah,
right? And
100%.
that can bite you in the butt, but you can just be competitive. So our
Yeah,
goal isn't the highest rent in the neighborhood for our properties and the ones we manage. That's not
yeah,
our goal. Our goal is to be the most competitive.
yeah.
Yeah.
And to be the most occupied as well,
And the most
because
occupied. Yeah. So we had, I think we had a lot of renewals for this year. I think we only went up in rent on maybe two
yeah,
out of, let me see, 11 out of 15. I think we only went up on two. Maybe no, we went up on 3 out of 15.
nice.
So that's like 20% of them went up, but we kept everybody the same,
I'm glad
and
you brought up the insurance. We're gonna dive into insurance because you're right. You may have everything perfect, and then we've seen this in the past that the insurance comes back and just totally destroys the deal. So we're gonna hit insurance hard. Next week we have a special guest that will be joining us, but
cool.
taxes is the other one too.
Hmm.
Um, he was, Magdiel was talking about some of these appraisals are starting to come in low because, as we've mentioned on the show in the past, the value of a property um, may 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 be what's at the end of this trend line, in 3 months or 6 months, and they're basing it on a trend line. So, although the comparables say, "Hey, this house is worth $400,000," well, 3 months ago it was worth 410 and 6 months ago it was worth 420. So they're going to be looking at, well, if it's been losing $10,000 in value every 3 to 6 months, it's going to
Hmm.
continue losing value. And so some of these appraisals, like Magdiel's saying, they're actually based on what they think the property is going to be worth in the next 6 months,
Right.
just based on those trend lines, right? So, um, what else are you seeing? Um, you know, I know you're doing private loans. I know you're doing some hard money loans, bank loans, owner
Hmm.
owner financing loans. Where um where are you seeing that you're getting like maybe the most value from, and how are you approaching these relationships with the deals that you got going right
I
now?
mean, obviously, like on the private side, you get people that are, um, they're not necessarily they want to they're not necessarily what's the word I want to use? Um, they're real estate investors, right? But
Hmm.
they're like very passive, right? These are the private lenders, and they're obviously very savvy business people too to be in that position to be
Yeah.
able to be a private lender, right? They've done something well for a very long time to get to that point, right? So they're very savvy. Private money, we've talked about that in the past. It's all relationship based. What I'm seeing though, that's a little bit different now on the hard money side, because I've been talking to a couple hard money lenders too, just to kind of, it's like having a tool in your toolbox, right? Is
Hmm.
I might not use it all the time, but it's nice to just kind of sharpen it every once in a while to see what's out there. So I've talked to a hard money lender last week, and I was asking like, hey, kind of what are your rates, or what are your points? And it was pretty standard. But he said, look, if you got money, that's like the 100% financing route.
Right.
You're going to pay the highest rate, you're going to pay the most points. But if you can bring 10%, maybe 20% of the total cost of the loan, if you
Hmm.
can bring it down, mean, I can knock, 1 or 2 points off. I can get you 1 or 2 points off the interest rate, and they just make it a little bit more attractive, right? Because now you got a little bit more skin in the game too,
Yeah.
right? So that's what I'm starting to see a little bit on the hard money side, but they're all kind of the same. They talk about relationships, but it's just really a numbers game with those guys.
Yeah.
With private money, though, you kind of need experience, right? You need a track record. I'm talking from the investor side. If investors are listening to this, I mean, obviously they are, and I think about how can I attract hard private money. You got to have a good track record,
Yeah.
and you got to get yourself out there too. How do you get your track record out there? Posting on social media, going to happy hours, going to meetups, right? I don't ever ask for anything because
Yeah.
everything that I'm doing, it's an opportunity for everyone that's
Yeah.
involved, right? Like there's no one's giving me anything for free. I mean, it just doesn't work that way. And so in return, right, they're bringing something to the table, which is capital. I'm bringing a deal and experience to the table, and everyone gets paid at the end, and everyone's happy, right?
Yeah.
And it's just kind of rinse and repeat until forever,
Yeah.
right? Until
The
we're just done,
the
right?
the finance world, they apply a credit score to us based on our strength and our risk when it comes to borrowing money
On
in
your
the
performance.
yeah, it's based on your it theoretically that's what it is. There's
Yeah.
some nuance to that that doesn't make a lot of sense when you dig into it, but the purpose of it is that score is
Hmm.
basically telling other lenders what the likelihood is of you paying back that loan. It's a
Right.
simple score. In the private money world, that number doesn't exist,
It
but the
doesn't.
concept certainly does exist. And
Hmm.
we've experienced this too. And it's like you're saying, like, if you're a deal finder and you're bringing deals to investors, they're not going to give you a 650 credit score or a 750 credit score. But if you keep bringing them nonsense or deals that just don't check out on paper, you're going to, it's almost like an integrity issue if you really think about it, because you're bringing deals that you're not spending the time evaluating, underwriting, doing the math, and you're trying to sell investors on deals that are weak. You're going to lose credibility, and that's a
That
social credit.
credibility, right?
Yeah, that's a social credit score of 450.
That's your capital, right? That's what you bring to the table, right? You may not have money, but like you mentioned, you're a deal finder. Well, okay, how good of a deal finder are you?
Yeah,
That's your credit score, like you said. That you nailed it. If you're bringing solid deals to the table every single time, like you're gonna have an 800 credit score plus, 800
yeah,
plus, right? If you're bringing crap, then you're going to be around 450. But let's say you bring a ton of good deals and you have a couple duds, right? Okay, that's not going to hurt you. You've got that capital, that
yeah,
that bank account now is like, all right, cool. I'm just going to make a couple withdrawals there because I shot a couple air balls,
yeah,
right? But I'm right back at it, and then again, it all boils back down to performance on some level,
right.
right? Whether you're performing on a loan or meeting your financial obligations, things like that, or you're performing as a deal finder, as an investor, that you're working with your private lender.
Yep.
Are you performing there too? So it's
Yeah.
it's it's experience and doing what you say you're going to do.
Yeah. It's
you know
it's credibility. So how do you get around that? Well, you need to watch our show so you can learn how to evaluate deals and
Definitely.
approach deals. And so we can walk into these real estate investments making money as soon as possible, not wasting time. How do you know how to evaluate those deals? Well, you got to keep good records. And that's what Magdiel, that's the very first thing he said, whether you're on the sell side. And if we had more time, I like to get into the sell side. What do
Yeah,
sellers need to think about?
I know you were
Because
going that. I know you were heading that direction because you've talked to me many times about either representing sellers or you're representing buyers, and you're talking to these sellers, and they've got notebooks, they got missing receipts, nothing is documented, and they're trying to value their property for a certain amount of money, and there's just really no good documentation to support that. And that just kind of makes, like Magdiel kept saying, like you're gonna have an uphill battle, right?
yeah, let,
And sometimes you don't make it. Sometimes the deal just falls through, um, and sellers don't get what they think that their property's worth.
and what I found, we have a deal. I'm not going to give you the numbers or tell you the deal, but there was a deal that was the difference between, check this out, on paper. between a 2 cap and a 9 cap because the financial records had unknown, miscellaneous. There was one expense item that said interest paid, and there's various, and those are all legit things. Like there's something reasonable, and there's a story, there's something honest behind those things, but the way it looks on paper, it erodes that cap rate. And yeah, Magda doesn't look at cap rates, but cap rates like the first component to get into that DSCR. You have to have a profitable. You can't pay a mortgage if the investment's not profiting. So your DSCR is going to be negative if you don't,
Hmm.
if you can't pay the mortgage, right?
Right.
So clean those. So for if you're an agent, for instance, and we have some agents on the call, and I've had to learn this the hard way, but don't list the property until those numbers look right, because what in our experience, especially buyers will look at a deal and say, "Hey, no, this doesn't make sense on paper." And then
Hmm.
you go back and realize, hey, there's something unrelated to the property on those financials, and then you get the financials cleaned up. Sometimes it's like that credibility issue. You just don't get a second chance to make a first impression. And that's all about, establishing credibility and building those relationships so you can close on those deals quickly when they come your way, right? So,
Hmm.
all right, well, that concludes our time for today.
Awesome.
As always, I learned a lot. Have a
Yeah.
wonderful day.
You
Any
too, man.
final words, Albert?
No, I've got Magdiel's contact information, so I think on our next multifamily deal, I'll give him a shot, and especially if he can get us connected with his counterpart too, that can help on like the purchase and rehab side, and then getting with Magdiel on the refi. So we're always looking for good lenders.
Yeah,
We don't really like to shop around. I think once we find a good lender, like we've been using the same refi lender for the past maybe 3 or 4 deals that we've
yeah,
bird. So, but it was good stuff today. Glad
yeah.
that he
If you're
on.
looking at making your first investment, call Magdeal. He is like the best person to go to first for when it comes to commercial financing.
Thanks for
And
getting me on, man.
also, Magdeal and I, and hopefully Albert, you're going to be there too. We have our deal flow. This is a separate event. It's our deal flow happy hour. It's going to be on Thursday in May. The what is that? The 21st from 4 to 7. Location to be announced, but be on the lookout for that. We'll buy you a drink and introduce you to some amazing people. So until
Cool.
then, have a fantastic rest of the day.
See you, man.
Bye.